From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Thursday, the 11th of the 11th, Veterans Day, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alex, it seems actually as if the equity market quite likes the bond market being shut. Maybe a sort of a distraction from the inflation narrative that seems to be everywhere right now.
Exactly. And also you have to question, is inflation bad for stocks in the beginning? It feels like that parameter and that dynamic has been shifting just a bit. As you mentioned, the bond markets are closed. So let's get right to the price action. S&P up by about 0.3%. It's tech, it's materials, it's a little bit of cyclicality and a little bit of those growthier names as well. To me, the bigger story evolving today, because we have that bond market closed, of what's happening with the dollar. Bloomberg Dollar Index, we're at the highest level since November of 2020, and you can see the effect on different indices. The pound, for example, is now at the lowest level since December. Euro dollar, we're off the lows, but still 114.68 is where we sit. And as we're dealing with these inflation fears, you're looking at Bitcoin and you're looking at gold up another 0.5%, $10. So it's like, how do you position for maybe more persistent inflation and a Fed that looks to be taking a little bit of a back seat?
Yeah, it's taking the patient approach. As you say, the precious metal markets just beginning to wake up now, which is fascinating. You can certainly see that in some of the London-listed gold miners who have been absolutely roaring over the last few days with their stocks really turning to the upside. Let's talk about the top stories we're watching so carefully this morning. Back from Baltimore, back in D.C., Bloomberg's Anne-Marie Hordern covering the latest from President Biden. Yesterday's inflation number really lighting a fire under the administration. Damian Sasser of Bloomberg Intelligence has all the details on those tough conversations that are coming up between the president and the Chinese leader, Xi Jinping. OPEC out with its monthly report as well. What's happening in the energy space? We need to focus on that. Bloomberg's Will Kennedy breaking it all down for us. And Disney. Disappointing. The streaming side of the business certainly not stepping up. We're going to deal with the earnings movers. Abigail has all of those. But let's kick things off back in D.C. President Joe Biden says his soon-to-be signed infrastructure legislation is part of the solution to the accelerating U.S. inflation story. Anne-Marie Hordern, Bloomberg's Washington correspondent, joining us now to talk us through this. How does spending more money help the inflation story?
Well, he says it's going to bring it down. And once again, yesterday, he pointed to this letter from a number of Nobel laureates, including Joseph Stiglitz. But in that letter, these economists that backed his plans for his economic agenda say it will bring down or ease long-term inflationary concerns. Right now, what this White House is up against is getting rid of and trying to mediate and ease short-term inflationary concerns. That's what people are worried about. And the president said we are seeing wage growth, we are seeing jobs market pick back up, but we do have problems. This is how he started his speech. And those problems he pointed to are rising energy costs. He pointed to it's much more expensive now to get a gallon of gasoline as it is a loaf of bread. It's not just energy, it's rent, it's food. All of this is playing out, and you can see tension in the Democratic Party. So we heard from Senator Manchin, who has really blasted the Fed for calling it transitory for a number of weeks. Yesterday, he was at it again. And then you have others on the progressives wing, climate hawks, like Senator Markey, Senator Warren, saying the U.S. needs to step in, try to ease some concerns when it comes to energy. And we're still waiting to see if there is going to be a response from that OPEC snub to the president.
Yeah, that's going to be really interesting to see what that is. If you see export ban, I don't know. We're going to talk about that later on in the show. Anne-Marie, thanks a lot. Anne-Marie Hordern joining us from Bloomberg. At the same time, President Biden and his Chinese counterpart Xi Jinping are now scheduled to hold a virtual summit next week. Now, the meeting comes as ties between the world's two largest economies have quietly improved in recent months, even as the nations are sparring over Taiwan. Here with the latest is Damian Sasser, a chief EM credit strategist at Bloomberg Intelligence. And Damian, this comes as we're looking kind of like, the layout of what the government's going to look like.
And it also comes amid a troubled property sector. Another day, another default avoided in China, so that's good news. And we actually saw a lot of rhetoric in the local Chinese periodicals overnight, basically talking about relaxation of lending to the mortgage sector. In fact, what China did last night, which is quite unusual, is they released monthly mortgage lending data for the month of October just to kind of placate the market. But you're absolutely right. The Xi-Biden summit is going to be absolutely critical. We're going to focus on tech and trade. South China Sea, obviously Taiwan in focus, especially after Congress sent a delegation there just yesterday, which was not received very warmly by the South China Morning Post. And then obviously it's going to be a range of other factors like human rights. So yeah, a lot to discuss there for sure. And yeah, in the wake of the climate accord that we seem to have reached last night. I mean, remember, it was a bilateral agreement between China and the U.S. which preceded the Paris Accord back in 2015. So this is a step in the right direction following COP26.
Damien, great stuff. Thank you very much indeed. Damien Sasser at Bloomberg Intelligence. We'll be hearing a lot from Damien, I suspect, over the next few days. OPEC Plus says it is focused on ensuring a steady supply of crude to global markets and isn't targeting a specific price. The group will review the pace of production hikes in the first quarter. Consumer nations, of course, including the United States and India, plus a bunch of others, continue to call on the cartel to pump more coal prices that have climbed almost 60% this year. I understand we will not get news on the potential release of the Strategic Petroleum Reserve in the United States today. It is Veterans Day, but maybe that is coming and coming shortly. Will Kennedy, Bloomberg Executive Editor for Energy and Commodities, joining us now. How long can this standoff continue?
It's going to continue perhaps for a few days yet, as you say, Guy. It's a holiday today. Also, I think they'll be conscious about doing too much on the oil market before the COP26 negotiations we were talking about earlier conclude. But clearly, the White House is very focused on the oil price. Yesterday's inflation print has increased their focus and made them really concerned about the cost of gasoline, as Anne-Marie was explaining a moment ago. So they're reviewing what tools they have. And I think clearly a possible SPR release, as we've been discussing for a number of days, is one. But also there are discussions, and some senators have pushed for this, on curbs on U.S. oil exports of ton type and a look at the mix of feedstocks that go into refining. And we might see a whole suite of measures if and when the White House eventually deals with this. I think that for the market, they're really caught in limbo right now between what is very robust demand, and we've seen several senior oil traders over the last few days explain that they think demand is already back at what it was before the pandemic, and people are flying more, adding to demand, and we've got winter months which increases demand for diesel. But as long as this threat from the White House exists, it's going to keep a lid on prices.
Especially the front month. Back end, though, re-rating just a touch. Will, thanks a lot. Bloomberg's Will Kennedy joining us there. All right, let's get to the earnings. They continue to make some headlines this season as the season draws to a close, highlighted today by some big outlook misses. Disney really front and center in that. Abigail Doodle now has a look. Hey, Abigail.
Hey, Alex. Well, Disney is front and center. But before taking a look at Disney, let's take a look at some of these other big earnings movers. To the upside, we have Tapestry headed to its best day of the year. This after Coach. The sales really went very well. And the buyback doubled to $1 billion. Open Door Technologies, a real estate company. And this stock had been down 25%. In sympathy with Zillow, they posted a narrower loss than expected. Shares bouncing back in a huge way. To the downside, though, Bumble down 13%, now below its IPO price. They had their first paid user decline since the IPO. We also see Beyond Meat plunging down 17%. They issued their second straight sales outlook that was under the street estimate. And that calls into question whether or not some of the pandemic trends are really coming to an end, because, of course, Beyond Meat had been doing very well on hoarding, and that could be a question around Disney, too. Let's take a look at a two-day chart of Disney, because Disney is plunging on the day. Here you can see it down about 8.6%, the worst day since March of 2020. That's the degree of the selling pressure, and as you know, Guy, it has everything to do with the Disney Plus subscribers. Not enough, folks wanting more. Some analysts saying for the long term they're doing pretty well, but you have to wonder whether or not that miss, if it has to do with fewer people being at home because of the pandemic trends coming to an end, or do they need more content? Because as we know, the streaming wars, it's all about content. But either way, Disney down very sharply.
That looks like one of their park rides, doesn't it? You're just going off the edge. That's
Space
exactly
Mountain.
what that
Space
looks
Mountain.
like. I've never been. I hear it's quite exciting.
It's really fun. It's my favorite.
I was just checking this actually on the terminal. Netflix is now, as of right now, is worth more than Disney, which I find amazing, considering if you put the streaming businesses side by side, what do you get for free in the Disney price? We'll talk more about Disney with our next guest. Thanks, Abigail, for the roundup. But we'll get more into the details about what is going on here. Disney, not the only company getting hit from rising costs. The bullwhip effect from supply chains starts small, then it increases, spreading across the globe. We'll talk about that more next with Katrina Dudley, Franklin Mutual Advisors investment strategist. She's joining us next. Looking forward to this conversation. This is Bloomberg.
For the first half of the year, we are still fighting. So we are trying to get really our suppliers managed through the crisis very well, through the supply chain problems. But for the second half of the year, there's hope that there's some ease from that perspective as well.
Siemens CEO Roland Busch speaking to Bloomberg earlier this morning after earnings. Joining us now, Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. You got supply chains, you got high inflation. That's the story. Everyone feels like inflation will slow, but I guess the question is, where does it slow to? And then how do you play that?
I think the fact is what is a normal rate of inflation? I mean, most investors have grown up in an industry where inflation hasn't even touched 2% over the course of their career, and they're just not used to it. So I think even if inflation settles in the 2.5, 3 range, it's much higher than what everyone is expecting. In terms of the timing of that, there's just so many components going into that inflation number. Obviously, rent is the big thing that we're focusing on at the moment because we're resetting those rent rolls. The higher home prices, well, they don't initially go into the rent number. Over time, you're going to start to see inflation there. And we're seeing it in various other things. We're talking about wage inflation. We're talking about transportation inflation. There's just so many inflationary impacts. The good news about it is you get this one-time bump, and then we start to go into normal. And I think that that's what we need to separate.
Did yesterday's high number change your thinking in any way about what you're watching when it comes to asset prices and which markets you want to be in and which ones you don't want to be in?
I think in terms of the number yesterday being high, we were expecting that because there's been so much that's been telegraphed in terms of the underlying data, and the compare was it really reflected the compare in that sense. In terms of looking at inflation, there's 2 components of it. The first thing is the ability of any type of company to be able to price for that inflation that they're seeing. So if you have a company, strong brand name, able to get that pricing, they're able to cover that price cost spread. So you need to look at that. That really impacts, say, the front end of the valuation. The other area where this inflation comes in is kind of the back end, and that's the terminal value. So when you have these companies where you are discounting long-term cash flows because they're loss-making today and they're not getting to profitability for 5, 10 years into the future, that kind of inflation pressure obviously causes pressure on the discount rate and decreases that terminal value. So we do think that you need to think of inflation the same way we think about stock picking, really understand where it's coming and where it's playing, both from a business model perspective as well as from a valuation perspective.
Okay, we'll get to the individual picks in just one second, but I just wanted to hit on freight rates because some areas of the market are seeming to come down in terms of pricing. Freight rates seem to be off their highs. And I wondered, if you read the tea leaves, what do the tea leaves tell you?
Well, the cure for high freight rates is high freight rates, because what does it do is it encourages the companies to go out and order more ships. And I have not met a shipping CEO in my entire career that does not like ordering brand new ships. And there's another element of pressure there. They're also being required to order green ships and trying to make their fleet greener. So they've got the pressure coming at them. So they're making a lot of money at the moment. Those rates are starting to come off the peak levels.
Yep.
From a stock picking perspective or stock perspective, we're looking at, when does the market start to price in these rates coming in lower? Because I do think that they're going to come down. You just had on earlier Roland Busch talking about, for his second half, which is the second and third quarter of next year, they're expecting these supply chain pressures to start to abate. And if you have the abating of supply chain pressures, we're going to have rates come down as well, because the high rates are really just reflecting the tight supply chain that we're seeing at the moment.
Katrina, why are more ships going to help the situation? I look at the story off Long Beach, and there are just ships parked up as far as the eye can see.
Yes.
You can send more ships over, but if they can't get the stuff off the ships onto the ports, onto trucks, then we've got a problem. The problem is the problem in ships, or is it the problem elsewhere?
In the ports, I think what the problem is it's actually the pandemic that takes out parts of the workforce, due to close contact or something. So actually, from that point of view, the announcement of the Pfizer, developments on COVID and the ability to take medicine to cure it is going to be great. We are seeing higher vaccine rates as well. So to the extent you can put the pandemic behind them, they will be able to deal with those port issues. But unfortunately, the port issues came at a time when we were shipping the most product into the port, so the peak season. So as we come out of the peak season, you'll start to see that backlog of ships come down, and you'll see them being processed through the ports, being transported out. In terms of the trucking side of things, companies are starting to pay up for drivers, and when you start paying more money to the drivers, you do attract people back into the industry. And in terms of being an industry that's very COVID friendly, this is an industry where you do have very long periods of time where you are by yourself in a truck, so you don't have any type of contact. So I think this is one of the areas in trucking where you can get people coming back into the labor force, so basically an increase in the participation rate. The final element you talk about it is more ships just mean that there's more capacity in the market, and that's always been a negative indicator for freight rates, and I don't expect this to be anything different.
Okay, so how are you playing it? Top pick.
In terms of a top pick there, we are not playing the shipping companies. They are extraordinarily volatile. They've had really strong runs. I think Hapag-Lloyd is up like 140% this year. So they're really, you've really seen this play out in them. Where we're looking is playing some of the recovery plays. I really do think that theme and that thesis going forward has really been underappreciated. So, for example, we look at, I would say, the safe recovery plays. So something like an AerCap. They are the people that you go to when you need to lease an aircraft. They will benefit from the fact that they're no longer having pressure on air lease rates as the airlines are recovering. You look at the email that United said, they're thinking of 50% increase in traffic. That's good for an air leasing company. So we like playing those types of things where you don't have so much volatility, but you have a lot of upside on the long term.
Why do you like Disney? Let's talk a little bit about Disney. We were just looking at the numbers. It's a complete change of gear, but Netflix is now worth more than Disney. Does that seem right to you?
It has been worth more at various points in time, so that was not necessarily a surprise to us. Look, what is the problem that is happening at Disney is it's this, you need to balance the short-term numbers, which are the lower subs than expected at Disney+, and then the long-term, which is how do you fix that? And they're fixing it with content. You had a look at what happened to Netflix. They had weaker sub numbers. They fixed that with content, and Disney is doing that exact same playbook, and they're talking about that incremental investment in content. So, as a parent, the fact that Disney's putting on more content means my kids are probably going to be watching more television. So I have to say, putting on the parent hat, maybe not such a great thing. But in terms of Disney stock, getting more content is a very big positive for them. And we see, you look at the strength of the franchises, you look at their ability to extend those franchises into other areas. They're not just focused on the core, they're able to expand it. But they really did suffer from COVID because a lot of their content was not COVID friendly in terms of being able to produce it. And I think now we're out of COVID as far as we can see. We see, it's probably about, a 6 to 9 month delay before they can fix that content issue. And we're a long-term investor. So I look at a stock that's down 9%. I think that people are too myopically focused on the short term, not thinking about the long-term value of that franchise. And, I think that it's a good time for, if you're looking to add to a Disney, I think this, these prices, when you get these short-term sell-offs, they're all the things that we look to as a value manager.
Before we let you go, I just want to get your take on what another way you play the recovery is, because I feel like that's been a bing-bonged all over the place. Value tried to take a run for it, didn't work out. Growth is still really front and center. What else do you do with a recovery play aside from AerCap?
So some of the things that you can play in a recovery are the hotel stocks, which are the easy plays, like an Accor is a name that we owned in the portfolio. It's the largest hotel company, out that operates that no one in America basically knows, because most of their franchise properties are outside of the region. So you've got something like that, which makes a lot of sense in terms of, playing this type of recovery. The other area is we want to, in terms of the growth versus value, inflation and normalized economy, I do think are good for value. But I think that the way we've been looking at value traditionally on, the simple price to book, simple price to earnings is not the way I see value as an investable thesis going forward. We are really taking the time to step back and look at what are the cash flow trajectories of these companies, where are they positioned, how are they executing, how are they handling the supply chain. So I think what's happening in the market when we talk about the underperformance of value is we're just taking that simple lens, and under that lens what you see is, value is in the banks and energy, and not necessarily value in other parts of the market where you have cheap valuations on, very strong cash flow streams.
Fair enough. Katrina, always good to get you here and on set. Thanks very much, Katrina Dudley of Franklin Mutual Advisors. Thanks very much. And stay with us for supply chains. We're going to have an exclusive interview with Lance Fritz, Union Pacific CEO. That's coming up in just a few minutes' time. Really looking forward to that conversation, Guy.
Yep, we certainly are. Looking forward to having a real deep dive into the supply chain story and figuring out where we go from here. What are we going to talk about next? Was it prepared? Did that poll over the weekend really have an impact? Elon Musk dumping a bunch of Tesla stock. The world's richest man has now collected more than $5 billion in sales. We're going to talk about that next. We'll do that in just a moment. This is Bloomberg. 25 minutes past the hour, Tesla. Let's talk Tesla and figure out what's happening here. Shares coming back a little bit, rebounding from the drop caused by Elon Musk's decision to put his own ownership plans up for Twitter on a poll over the weekend. Then he comes through and confirms that he is basically going to be selling a bunch of stock. Dave Wilson, looking at the price action and the impact that Elon Musk can have.
Indeed. And yesterday, we got all the filings for this week. He was selling shares, Musk was, on Monday, on Tuesday, on Wednesday. You're talking about a total of 4.5 million shares. And you mentioned that $5 billion number already, Guy, in terms of what he took in. Now, some of that is going to offset taxes on stock options that he has that are exercisable through next August. And we should also point out that those sales were set up ahead of time in mid-September, well before that Twitter poll over the weekend where he was asking people whether he should sell 10% of his Tesla stake. So, there's something more going on there. I mean, and let's face it, these shares have done relatively well in the past year, even when you compare them with other trillion-dollar companies. Elon Musk with a 17% stake, by far the largest holder. And so there's all the reasons right there to suggest that, Musk may well be selling more.
All right, Dave, thanks a lot. Really appreciate it. Dave Wilson joining us there. Coming up, very special guest. President Biden is saying that he's going to try to tackle inflation. We're going to talk about that with Lance Fritz of Union Pacific.
Many people remain unsettled about the economy, and we all know why. They see higher prices. They go to the store or go online, and they can't find what they always want and when they want it. And we're tracking these issues and trying to figure out how to tackle them head on.
That was the president speaking yesterday in Baltimore, trying to ease growing concerns as inflationary pressures continue to hit Americans, everything from the gas pump to the grocery store and everything in between. Joining us now to discuss all of this in an exclusive interview is Lance Fritz. He is the Union Pacific CEO. Union Pacific, of course, is one of the largest transportation companies in the United States. I think that kind of understates it a little bit. Lance, really appreciate your time today, as ever. Thank you very much. Let's talk a little bit about where we are in this journey. Clearly, we have been focused for many months now on supply bottlenecks. What does the outlook look like from here as we go out of this year into next year?
Yeah, thank you, Guy. Thanks for hosting me. So let's start with the good news. The good news is the reason why we're in this kind of supply chain constraint is that the economy is good and strong. Consumers are buying and there's demand. So that's a great place to start. COVID has definitely had an impact on the supply chains. all across the supply chains, whether you're at factories in Asia or other parts of the world, coming across the water in our ports, or on the middle miles and the final miles getting it into a warehouse. Our perspective is it's going to take a while to dig out of the hole we're in, and it's mostly about getting labor into jobs. We need more truckers. We need more warehouse workers. We just need to be more fluid so that we can match supply of capacity with demand from consumers.
So there's lots to unpack there, Lance, and I echo, guys, thanks for joining us. I just want to focus on some of the specific recent action that you guys have taken, especially to help clear the port position. And we'll get to labor in a second. But you're looking at things like supply chains working 24/7 on the West Coast, offering incentives to in-gate containers on weekends, improving the driver experience on some ramps and some apps, et cetera. What has been the tangible results of these initiatives?
Yeah, great question, Alex, and thank you. So we play the middle mile, and we take boxes from port facilities, get it onto the railroad, get it into an intermodal ramp inland, so that a truck driver can get it off of us and into a warehouse. What we've done in all across that network, we're a 24/7 company all the time. In the LA basin, we had one intermodal ramp that was serving the ports that didn't work about 20 hours a week, 20 hours out of all the hours in the week. And so we opened it up for those hours, and we also put on an incentive for anyone to use us during those new hours. You got, as a shipper, you got an extra $60 for that box for bringing it to us during that time frame. Now, we haven't seen a lot of demand for that, but I think the most important aspect is we're taking things off the table. We're showing up and we're demonstrating that we're part of the solution. And then you talked about technology. One of the ways we can help tangibly is to help truckers get on and off our ramps quickly. So we're using our UP Go app, so they're paperless onto the ramp. We're getting them to their destination in the ramp, the parking spot, with excellent signage. And our truck partners are now getting through us much more quickly. That makes them more productive, and it helps us get more street throughput with the assets. So it's a big, big deal.
In terms of the supply chain issues that you yourself are facing within the business, what are they? Alex mentioned labor. Are you experiencing shortage of anything you need to keep your infrastructure running? What's the picture in terms of operating Union Pacific right now?
Yeah, Guy, we're the middle miles. And so if there's congestion on a port facility, or if truckers and people can't take boxes off of our ramps in Chicago, say, we start getting bound up with inventory. Right now, we're fluid. Ports look like they're about normal in terms of getting a box from a ship onto a railroad. And on the other end, we're not having an excess amount of inventory on our ramps. We do see in certain parts of our network that COVID's having an impact on our crew availability. First, in terms of crews that have to quarantine because of exposure. Second, because we're part of a vaccine mandate as a federal contractor. And so we give time off to our employees to get vaccinated. And that's costing us a little bit of crew availability. And then because we have a little bit of mismatch, imbalance in some of our resources, we're not using our crews terribly effectively at this point in a couple of pockets in our network. But all in, I wouldn't say labor is a deep concern. I'd say the availability of labor to us, mostly related to COVID, is a modest concern.
So when does that resolve itself? And I'm wondering about the mandates, too, because there was a narrative that was debunked by some of the CEOs from airlines that, like, the vaccine mandate for airliners led to less crew. Have you seen that? Is that a thing? Does that happen? And what is it on COVID? Like, if we don't ever really end COVID, how do you manage this?
Yeah, that's a great question, Alex. It's a frustration for all of us as CEOs, certainly for me personally, that there's no clear articulation of an end game. You know, so right now, because we're a federal contractor, we're demanding that our employees get vaccinated or have an accommodation, either religious or medical. And that's hard. We've got a lot of independent thinkers in our workforce, rightfully so. They're excellent. And some of them really don't like being told what to do. They'd like to be able to continue to go through the process and make these decisions for themselves. And that's largely being taken off the table. Now, I have no idea if that turns into a labor issue for us at the end. I sincerely hope not. and I anticipate it won't. But right now, as they are getting vaccinated, we're giving them time off, in order to go get the shot, as well as if there's any side effects to the shot. And that's costing us a little bit of availability, and it's real. It's marginal, but on the margin, it matters.
Lance, should America be investing in railroads? The president has an infrastructure bill. He's about to spend a few bucks here and there on improving America's infrastructure. What role do you think the railway should play in that?
Guy, the coolest thing about American freight railroads is we fund ourselves. Union Pacific generates about $20 billion in revenue a year, and we invest about $3 billion in capital a year. So we really do not need to look to the government to get our infrastructure in really good shape. The last report card put out on American infrastructure by the Civil Engineering Association basically said railroads get a B+, and the thing that drags us down is Amtrak. So I think it is good that the infrastructure game plan has dedicated funding for Amtrak where public funding is really needed. And then, of course, we would love to see a continued emphasis on our public-private partnerships with some of our local communities when it comes to separating roads from railroads. And some of the money in the infrastructure plan can be used for that.
Lance, I bring this up because there is this argument that I'm increasingly hearing that Europe has a lower inflation rate at the moment. Europe is having to deal less with issues that you've described in this conversation because it has a larger, more integrated railway system that, as you say, both deals with passengers and with freight. Does that argument fly, do you think?
I don't think so, Guy. The U.S. freight railroad system is the envy of the world. We ship a ton of freight at a lower cost in absolute terms than anywhere else in the world. And we do it efficiently and we do it reliably. So it's not, I don't think, because some other country or some other region has a better freight rail network. I think the reason we're seeing more inflation in the United States than in Europe is that we're growing faster. There's more heat to our economy and demand is up stronger, which is a great thing. But it can be resolved and will be resolved. Our economy does a great job of putting resources where they're needed to take care of bottlenecks and constraints.
To stay on the DC point for a second, the infrastructure bill that's going to be signed on Monday and then potentially this human infrastructure bill, net is more demand, more stuff is going to be moved around the U.S. And I'm wondering, how much room do you have to increase productivity? You've already increased it so much. So without having to go down the labor shortage route issue, how are you going to meet that kind of demand? How do you increase that productivity even more?
Well, we are out in the marketplace hiring, Alex, and we'll continue that. Now, but to your point, we are a very productive company, and we won't have to hire one for one as volume comes on. We have room to continue to grow our train size. Our network can handle that. And we have room to continue to consolidate our trains so that we have fewer crew starts. The more efficient we are at using our assets and our fixed railroad, the more productive we are. And there's still plenty of opportunity there. So I feel really, really good about the future prospects, both of the U.S. economy and our role in it.
What are people moving around right now? From commodities to stuff. What's the biggest thing?
Yeah, Alex, so we look at our business in 40 lines internally. We break the revenue line down to 40 subsegments. I'd say of those 40, a low 30s number are all up year over year. And it's really across the board. The industrial economy is doing well in steel, in plastics, and industrial chemicals and refined product. The bulk world is doing well when it comes to grain, when it comes to rock, construction material. The places that we're seeing a little bit of pressure tend to be very specific and rifle shot for a reason. Like, for instance, chip shortages for the automobile industry. That means our inbound auto parts and our finished vehicle shipments are down year over year. They're starting to get about even, which is good. So they're starting to make up a little room, but we're still down. And we're down on international intermodal because of disruption in the international intermodal supply chain. Some of the ocean shippers are putting more into truck in LA, not onto rail. And it's causing our international intermodal line to go down. We're open for business. I can't wait for that to start growing back up again.
Yep. Lance, final quick question from me. I'm assuming that a lot of your trains, most of your trains, all of your trains run on diesel. What does the fuel bill look like going forward from here? What are you planning on? And in a world where we're wrapping up COP in Glasgow, do you see a world in which you could see the huge infrastructure that you've talked about today being electrified?
Yeah, to a degree, Guy. Great questions. And you're exactly right. For us, fuel is by far our largest cost. And it's also by far our largest emission source. You know, think 90% of our emissions come from the burning of diesel fuel in our transportation plan. So the first thing we're focused on is using our locomotives wisely and efficiently. We call that consumption rate. Anything we can do to drop our C rate, which is how much diesel it takes to ship a ton of freight, is good. And we're making progress there. We had really good progress in the third quarter, and we're looking forward to continue to improve that. And the second thing we're focused on is using different diesel fuels like biodiesel and renewable diesel so that we can be more sustainable even though we're burning diesel. Then the third thing we're doing is we've committed to buy battery electric locomotives and start converting some of our ramp operations, some of our terminals into electrified terminals. I think that's the first place that we'll see battery electric locomotives really pay off, and there's an opportunity for that as well.
Really looking forward to updates on that, Lance. Thanks very much for your time. We deeply appreciate it. Lance Fritz, Union Pacific CEO. Thanks a lot. All right, coming up, we're going to stay on the commodity story. OPEC expecting the U.S. shale producers will pump more next year. They revise their demand a little bit lower for this year, but stay firm for next year. President Biden facing some pressure to cool down this market. More details. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Michelle Meyer, the Bank of America head of U.S. economics. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First World News. I'm Ritika Gupta. President Xi Jinping has delivered the first doctrine on Communist Party history by a Chinese leader in 40 years. That gives him the mandate to potentially rule for life. Only Mao Zedong and Deng Xiaoping have authored a so-called historical resolution, and both used them to dominate party politics until they died. SpaceX has launched its third crew of astronauts to the International Space Station. The Falcon 9 rocket and its crew of 4 lifted off late Wednesday from the Kennedy Space Center. It's scheduled to dock with the space station later today. The astronauts will then begin a 6-month research mission. In South Africa, the last president of the apartheid regime has died. F.W. de Klerk took power in 1989. He removed a ban on the pro-democracy African National Congress, released Nelson Mandela from jail, and managed South Africa's first all-race elections in 1994. He and Mandela were awarded the Nobel Peace Prize. F.W. de Klerk was 85. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy?
Ritika, thank you very much indeed. So OPEC is cutting its forecast for global oil demand growth thanks to higher prices. Joining us now with more on this story is Javier Blas, Bloomberg's chief energy correspondent. There is a standoff between the White House and OPEC Plus. Who blinks first?
I think that President Biden is going to blink first, and I think that we're going to see action from the White House in the next few days. Biden asked OPEC to add and increase production larger than that 400,000 barrels a day that OPEC is doing every month. OPEC, led by Saudi Arabia and Russia, said no. So the ball is clearly on Biden's court. And he has been indicated that energy is a big reason why inflation is at a 30-year one high. And I think that he's going to try to do something about it.
So I guess the question is, what? Because I have a list of possibilities. One, we have the SPR release. You could speed it up and front load it, right? You could take off some biofuel requirements that you have, and you could restrict exports. You could ask the industry to pump more. I mean, what do you think he's going to do?
Well, I think that probably is a combination of all of the above. I think that if the administration wants to have an impact on prices and send the cost of WTI down from 80, 85 that is trading currently to something closer to 70, 75, it's going to have to be all of the above to obtain some movement. Obviously, perhaps the one that create a bigger headline is the SPR release and an export ban, and potentially those are the ones that also are effective and they don't achieve as much as the administration would like. The one that probably creates the biggest downside for gasoline prices is tweaking the biofuels mandate, but that has big implications for domestic politics because it will really not make farmers happy whatsoever.
Alex gets excited about that kind of stuff, like what can we do here, what can we do there? I'm sure you do as well. I want to know what this is really about. And what is fascinating is that the Crown Prince has yet to go to the White House.
I think, the guy, you are really nailing it down. I mean, this is as much about the oil market. It's about politics and it's about personalities. Biden has not met Crown Prince Mohammed bin Salman, the Crown Prince of Saudi Arabia, has not spoke to him on the phone either. And I think that the Saudis want the rehabilitation, the diplomatic rehabilitation of Crown Prince Mohammed bin Salman, and they really want to see movement there in Washington. And the White House is very reluctant to do that. So far, they have been sending officials. Jake Sullivan, the National Security Advisor, was in Saudi Arabia recently. Well, John Kerry was also there and met the Crown Prince.
So if the President of the United States picked up the phone and called the Crown Prince, oil prices would likely go lower because the Saudis would do what?
I think that the Saudis will increase production larger in December than otherwise, and I think that we see the prices of oil going down. This is about politics. This is not about the oil market.
So I understand it's about politics. So that's why I don't understand why President Biden doesn't just pick up the phone to shale producers and say, what can I do to get you to pump more? There's a lot of ducks drilled but uncompleted wells just like hanging out in the U.S.
He can do that, but it will be a big U-turn of policy for President Biden and for a lot of people inside the administration who believe that climate change is a much bigger priority than bringing the price of oil down. And we are in the middle of COP26, so that is a very difficult situation. But I think that perhaps I'm overreading this, but I think that we are beginning to see a recalibration of energy policy from the White House. The way that President Biden spoke, for example, in Glasgow about the need to keep oil prices down, about investing in oil because Americans are still mostly driving gasoline and diesel cars. I think that it was a very interesting one. Surely oil people in Texas would like to see more from the administration, and Republicans would like to see more, but there has been already a recalibration of energy policy.
Interesting. Javier, always a pleasure. Love the reporting. Thank you so very much. Javier Blas joining us. And make sure to tune into Commodities Edge because obviously we're going to talk about that. Plus, I spoke to Indonesia's Minister for Maritime and Investment Affairs. We talked about what Indonesia is doing. They're a huge supplier of dirty coal to China, which has been booming, hitting a record in September. How does that fly with COP26 commitments? We're going to break that down. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Apartment rents in Manhattan rose by the most on record last month, according to appraiser Miller & Samuel and brokerage. Median rent rose 18% in October from a year earlier to almost $3,400. It's the biggest annual increase in data going back a decade. Many New Yorkers are looking for nicer places to live as they anticipate going back to their offices. Daimler's truck unit plans its stock market debut on December the 10th. During its Capital Market Day, the company said it will pursue a 40% dividend payout ratio target. Daimler reiterated that it has a double-digit margin target by 2025, assuming favorable market conditions. And Bloomberg's learned that Boeing may win a crucial deal as early as this weekend from an Indian startup airline that would dent Airbus's dominance in what was until recently the world's fastest growing aviation market. The airline, Akasa, may buy up to 80 737 MAX jets. And that is your latest Business Flash. Guy, Alex.
A couple of things to say about that, one of which is this Dubai Air Show coming up. So I suspect that order may well be announced at the show, though I thought Airbus had a stronger presence at the show than maybe Boeing did. The other thing is, Alex, that Airbus is pretty much sold out. You want to buy a narrow body right now from Airbus? They control the market in so many areas. You got a long wait. If you're a startup airline, you need aeroplanes. You can either go to AerCap, and we were talking to Katrina about that a little bit earlier on, or you can maybe go to Boeing, who have the ability maybe to service your needs a little bit more quickly.
Here's my question. When is there that third player in the market? Like, okay, I get that Airbus has no more like narrow bodies left, et cetera. But like, when do we get the other competitor where we actually kind of heat up this space?
It's been a duopoly, obviously, for a very, very long time. But Comac is coming into the market. Next year, you're going to see the Chinese really entering the market. It's going to be interesting to see whether carriers outside of China actually end up buying Chinese aircraft. They're going into the narrow body part of the market. That's probably the easiest part of the market to enter, but it's still ferociously competitive between these two. And obviously, Boeing and Airbus are pretty good at making airplanes. And then you got to go a little bit further down into the kind of Embraer kind of area. But to be honest, narrow body market, Airbus absolutely dominates this. What does Boeing do next? I think is the big question.
Yeah, okay, more questions, but we got to go. Tape's going to cut us off.
We
I'll
do.
ask you in commercial break.
Well, we've got a little while left. We've still got 20 seconds. We could talk about this a little bit more. I'm sure I can
I was just going to go to when we're going to get hydrogen planes and like when we're going to see those kind of orders start to come in and how long that's going to be.
GE are really big on that right now. So that's where GE is going to be working with Airbus. That's a huge story. Anyway, we're going to talk about the European earnings season next. This is Bloomberg.